When I was 25, I bought my first property in the UK, and I can easily say that was the most stressful experience I ever had. Despite the fact that I was already prepared financially, there were so many hurdles along the way during the process, and the entire journey to get your first property might take several years, and for me it took a couple of years just to prepare. So in this video, I want to share with you 4 key steps that will help you be prepared to get your first property. Number 1 is credit score. A credit score is pretty much a metric that tells lenders how credible and reliable you are as a debt payer, so that they could know to lend you the money. The credit score is used by credit institutions like Equifax and Experian that check people's records, whether they have taken out a loan, are they repaying the loan on time, and how credible they are. Those institutions even know if you're paying your broadband at home on time or whether you've bought a phone on a repayment plan. And then they share that information with lenders. For example, if you're applying for a mortgage with your bank, the credit score goes from 0 to 1000 or 0 to 800, depends on the app you're using to keep track of it. And they also give you the average national credit score, so the average credit score of the entire country or the county or area you're located in, so that you can compare yourself with other people in the area and recognize any changes that you might be able to do to improve your credit score. It's a pretty helpful measure because they have color coding as well, so if you're in the red or yellow area, you can pretty easily say you're not doing as good. And those apps also list for you some of the points you can improve on. For example, you might have a low credit score because you haven't been paying your credit card on time, so that will be one of the things listed in the app when you're checking your credit score. So it's pretty easy to recognize what's pulling your credit score down. Personally, I've been using the app ClearScore. This video isn't sponsored by them, so I'm just mentioning what I'm using. I've also tried Experian, so that's a pretty good app as well. They're both free to use, just download them on your phone, register. And when you insert your personal information, it will automatically search this database, and it might recognize any existing loans you may have or repayment plans or utility bills you'll sign up for. So it's a pretty easy setup, so I do recommend if you're planning to apply for a mortgage or a loan, do make sure to check your credit score beforehand. Number 2 in being prepared for your first property is to assess your personal finance. The main thing lenders look at when you apply for a mortgage or a loan is how much money is coming in and out of your account. So that means they're checking for the disposable income, the net amount of money you're left with by the end of each month, and not as much as what salary is just coming in. And to assess your personal finance situation is something pretty easy that you can do at home. Just grab a piece of paper and a pen, or just open a spreadsheet on your computer. List all of your income sources, so all of the money that's coming in. Don't bother including any dates, that's too specific. What we want to look at is your monthly income and then the annual income. For most people that have a day job, the monthly income is going to look absolutely the same throughout the entire year. Whereas people that are working as a freelancer or a contractor, the monthly income might vary from month to month. So make sure to record your monthly income for each separate month so that by the end of the year you can calculate the annual income. The other thing to do is to write down all of your outgoings, so all of your expenses. There's some fixed expenses that don't usually change and are recurring, that have to do with your main way of life. Those can be rent, food, fuel for your car, utility bills, broadband and phone contract. Those usually don't change from month to month in terms of costs, so make sure to put them in a single column. And then in another column, make sure to put any outgoings that are unplanned. For example, this month you've decided to go on a holiday, bought yourself something nice because you're hardworking and you deserve it. Make sure to put down each of those expenses every month so that by the end of the year, you'll be able to calculate the average expenses you have per month. You don't need to do this for 12 months to understand where you're at with your outgoings, because usually our spending habits are pretty much the same. So you can either do your budget tracking for 3 months to understand what's happening on a quarterly basis, or you can do it for 6 months, which is going to be pretty much representative of your way of life, your income, your outgoings, and will give you a pretty solid figure of what your disposable income looks like. And again, lenders are looking at the disposable income, so it doesn't matter really how big of a salary you're taking home. If you're spending most of it by the end of each month, then lenders might not approve you for a mortgage, so make sure to keep that in mind. Next in line is the affordability score. Now, affordability score has nothing to do with credit score. Unlike the credit score, the affordability score isn't gauged from a 0 to 1000, but is a combination of many factors. All those expenses and the income we just mentioned all take part in forming your affordability score. The affordability score is the main metric, the final grade that will decide whether the lender will approve you for a mortgage. Not only do the credit score and all of your expenses and income play a vital role in the affordability score calculations, but the affordability score also makes use of a lot of information about you that is in the financial system, whether you have any debts, for example, a car loan, whether you've had any debts before, for example, you took out a phone repayment plan, but you've paid it all out, whether you're financially taking care of other people in your household. So even if you have the highest credit score, since that's calculated for you as a person, the affordability score takes into consideration whether other people are reliant on you financially. For example, if you have children or a partner or parents that you're taking care of financially. This is why it's really important to have a high disposable income so that these factors can be compensated for. The credit score looks at all of your income and whether you've been repaying all of your credits on time, whereas the affordability score also takes into consideration all of your expenses. So when I applied for a mortgage, I got rejected, not because I had a bad credit score. Quite the contrary. I was already working full-time, I had a regular income. I also had been using 2 credit cards to build up my credit score, and I've been repaying them every single month on time. The reason I was getting rejected for my mortgage was because of the outgoings, and the affordability score turned out less than what I expected. I was living in Slough and my rent was $850 before the utility bills and before the council tax. I was also driving a car, so I had the annual insurance for that, the MOT and all of the maintenance. My fuel cost me £150 each month. My car's insurance was £1,200 per year. And all of that combined with my broadband, phone bill and the food shopping each month, my affordability score was simply not enough for the lenders to approve me for a mortgage. So I moved back to Portsmouth, started paying less rent, I sold my car, applied for a mortgage and got approved straight away. But I talk about this in another video. Next up is saving for your deposit. Now this is probably one of the most time-consuming parts in the process because it might take you years to save up thousands of pounds or dollars for a deposit before you apply for a mortgage. The deposit is an amount of money you need to have saved up in your bank account before you even apply for a mortgage. The deposit amount is usually a percentage of the entire price of the property, and that percentage depends on the type of the property you're planning to buy. For example, in the UK, if you're planning to buy a house and it's your first property, then the deposit amount you need to have saved up is 5%, whereas if you're planning to buy a flat, the lender might require you to have 10% as a deposit. My first property was a flat/studio apartment, and I had to save up 10% for the lender to approve me for my mortgage. And what those percentages mean in terms of numbers? Well, let's check out an example. For simplicity's sake, I'm not going to mention the currency, just the numbers. So if you're looking at buying a house that's worth 200,000 and the deposit requirement is 5%, then 5% out of 200 is 10,000. So you need to save up 10,000 in order to get approved for a mortgage that's going to be 190,000. And yes, the mortgage you're applying for is actually the property price minus the deposit you have saved up for. Now let's say you want to buy a flat that costs 150,000. In this case, the deposit requirement is 10% since it's a flat. So the deposit needs to be 15,000. So credit score, personal finance, affordability score, and deposit. All of the tick boxes you need to check to make sure you're successful. Another box you need to tick for success is that subscribe button below. Drop a like and click on this video because YouTube thinks you really like it. I'll see you in the next one.